back to the players. How relevant are they to the evolution we are seeing in the credit infrastructure space, especially for the digital lending? The default rate, like these things that we don't normally hear of. Anybody's like, oh yeah, business is good, we got funding, but are the investors unpack the cost of offering credits, especially for providers? If you don't understand regulations and you're not in compliance, then you also spend money if you're hit with any penalties from compliance. This is so lenders look at two things when they want to make decisions, right? They look at your capacity to pay and they look at your willingness to pay. Please, could you shed more light on that, those two decision points? From that, let's go into this very fancy and it's trending right now, this term they call buy now, pay later. What do you think about buy now, pay later and outgrowing e-commerce? So I'm taking the conversation back to the players. There was a before type kind of credit, very, very safe. And there is a now where it looks like people are beginning to be more risk averse and exploring, different demographics in what we have. And I want to find out, it appears to me, correct me if I'm wrong, that the credit bureaus, 3 of them are being disrupted. How relevant are they to the evolution we are seeing in the credit infrastructure space, especially for the digital lenders? Nifemi, I'd like your thoughts on that.
Interesting, right? First things first is regulation plays a huge role in their relevance, to be fair, right? So as a lender today, at least as long as you're a central bank regulated lender, you're expected to report every loan to at least 2 of the 3 credit bureaus, right? And I think before now, all was well in paradise when it was brick and mortar, submit a long application form. They were up to speed at that time. But I do think that in more recent years, credit bureaus have had to play catch up to the technology advancements that have entered the lending space in Nigeria. So as opposed to them now being more on top of the situation, they're now having to catch up with, a lot of the digital lenders and their pace and faster turnaround time. I gave the example of 6 weeks to get a loan approved, right? Back then, if you were updating your credit records once a month, if it's taking 6 weeks to approve a loan, it's fine. There's no problem, right? But now it's taking 5 minutes. So if you're updating your record once a month, that's trouble, right? And hopefully they get to catch up a lot faster than what they have right now. So yes, they are a crucial player because of regulation, but they can be doing a lot better than they are right now.
Thank you for that view. So we've been talking a lot about what takes place to give somebody a loan, a lot of decisioning, and all that, and profiling. And it looks like that's what a lot of people are focused on. A lot is not being said about the default rate and whether these monies are being paid back or not. And I want us to discuss that quickly. So what's the default rate like? These things that we don't normally hear of. Anybody's like, oh yeah, business is good, we got funding, but are the investors and investors happy? That's number one. And number two, to what extent did COVID affect people's capacity to pay as well as willingness to pay? Tope?
Yeah, so we can group risk appetite for lenders. There are broadly 2 groups. There are the traditional banks, both commercial banks and the microfinance banks. Then there are the digital lenders. Traditional banks and microfinance banks are generally more conservative. I think by regulation, they are expected to keep their portfolio at risk at around 5% or less. But I think digital lenders tend to take more risk and they have a larger risk appetite. And so they are open to taking higher default rates, probably maybe up to 20% or thereabout. But for COVID, yeah, definitely it's world over. COVID really, caused a lot of job losses everywhere. And if somebody loses their job, propensity to default has just gone up. There was a study, I think, published by, PwC or McKinsey sometime last year about the risks to banks on COVID. And default was one of the things that was mentioned because it will affect their a deposit to loan ratio or something like that. And just recently, UNDP also published that about 20% of all, of employable Nigerians lost their jobs as a result of COVID. And this is not just those in regular paid employment. We're talking of those who as well, small businesses as well. And so, while I don't have absolute values or what the default rate is, but, because at Indicina, lenders come to us to use our products. So, we hear the anecdote. The lender is saying, well, they have customers coming back to them to ask to restructure their loans because they no longer have the capacity to be able to pay what they were expected to repay at a certain time. So we've heard those stories. And while it's a sad thing, I do think that credit is still capable of growth in Nigeria and everywhere in the world. And, we should continue to look at ways to expand and democratize credit actually for everyone.
Thank you. I want to turn that question around a little bit, Nifemi, and ask again, because we are trying to provide insight into the credit business in Nigeria. And a lot of people see what the glory is or what the front end is. They're not aware of what's happening at the back end. So could you help me unpack the cost of offering credits, especially from a Nigerian perspective? I would like to find out.
So first things first is credit is expensive, right? To even give it out, right? I think for financial institutions, it's relatively cheaper, and it sort of gives them the advantage, and that's why you find that they will always offer the best rates, or their rates are like affordable, or they make sense. Even the optics of the rates make sense. For a commercial bank, they have deposits. We all keep our money with them. They have direct plugins to the likes of NIBS, so they can pull BVN, they can pull bank statements. They don't need to pay for some of the things that digital lenders have to pay for. So imagine a lender that has maybe a finance company license or even a state lender's license. For every loan that they need to disburse, they're making calls to the credit bureau, say maybe at as high as 200 naira per call. God help you, the call says there is not sufficient information inside, or it comes back that the person has never taken a loan before. You've made the call, you pay that 200 naira. For instance, you're checking their BVN, whoever it is you're using, maybe Smile ID, maybe Doja, maybe you verify. There's a cost somewhere between 50 to 100 naira just to check their BVN and be sure that this person is solid. You are going to meet, say, my bank statement or an Okra or a Mono. You're calling and bank statements. You are paying another between 50 or maybe between 30 to 70 naira, depending on your volumes and all that. At the point of disbursement, because you are not a financial institution, again, you're meeting a Paystack or a Flutterwave to handle disbursement for you. Disbursement can go as high as 50 naira to get credit to those people's account. And when it's time to even collect the loan back, you're being charged maybe 1% per repayment to get the loans back. And that's aside cost of regular SMSs that you need to send. Reminder, your loan will expire in 7 days. In 3 days again, your loan will be due in 3 days, or your loan is due today. Those are SMSs.
And then infrastructure costs as well.
Yeah,
we're not talking about server costs.
We've not even gotten there. There's now the customer service people that need to call them to say, oh, are you having any issues with your loan, or what's okay, we saw that you just repaid your loan, what can we do to serve you better? All those things. Then when we now even come to the in-house cost, right? You are looking at cost of engineers, PMs, operations people. If you're a digital lender, you're paying through your notes and your teeth to, data scientists, decision scientists, machine learning engineers. These are disciplines that you won't even readily find in Nigeria. So, you're paying in FX. God help you, you are raising equity in dollar, or you're even raising debt in dollar to disburse these loans, right? That means there's a cost of fund, right? Which can be from as little as, say, 2% per loan to as high as maybe even 5 or 7%. You're raising equity in dollar, you are giving loan in naira, you are collecting the money back in naira. Maybe you collected the debt equity when naira was 365, and you are paying it back as of now. Like it's expensive, and that's why you see
What?
that. Yeah, you
No,
can't tell.
I'm just exclaiming at everything you said now. So
Exactly.
I
So,
see.
and you can't tell the person that gave you money that dollar has gone up in your country. So at the end of the day, right, that sort of helps you to see why the rates that digital lenders are giving, a lot of them are actually really nice. They're, just making a little margin there for profits at the end of the day. Because after disbursing in a chunk, they still need to make room for the default rate like Tokwe had mentioned earlier. So for them, they can even be more accommodating, say 10-15%, right? But they still know that, okay, if we give out 100 loans today, 10 of them are not coming back, and so they have to adjust their rates in a way that even if it's only 90 that pays back, it covers cost and they are still able to make some money. So
That is scary. So 4 points or four major blocks. So spending money to make a decision, spending money to disburse after you've made a decision, spending money to recoup or to repay, and if you default, you spend another money to get the people that will recover the loans for you, and then spending money to run your business. God help you, you don't understand regulations and you're not in compliance, then you also spend money if you're hit with any penalties from compliance. This is it's crazy. I don't have any other word to use and describe it. So there are various things that have started off like this and they became much better. They're almost commoditized now, like switching. Do you think that with collaboration, there are many players now, doing different things. Do you think that with collaboration, the cost of offering credits would ever reduce in Nigeria, make it more profitable to offer people loans? What do you think?
Yeah, Nifemi highlighted along the entire value chain where businesses or lenders have to spend. I think just generally, the way, like he mentioned, for example, that banks have access to NIBs to be able to pull statements directly. They have access to BVN to be able to get BVNs without having to pay some other person. I think if there are ways to make those kind of things more accessible to even the digital lenders, allow them to be able to reduce the cost of lending, it will really go a long way to help them. I know that with credit bureaus as well, of course, there's a cost to pulling a credit bureau report. And not to slide the credit bureau guys, Nifemi said they're playing catch up, and truly they're trying to catch up. They've started to create smaller reports that are not as data rich, but help to do quick decision making as well. So they have some smaller reports that are a bit cheaper, that digital lenders can use to make credit decisions. The digital lending space, I think recently some digital lenders decided to come together to collaborate on a sort of blacklist that will allow them share data about the defaulters in their space. It would be very useful if Quick Cash is able to get data on Quick Loan to know that customer A is already has a loan there and is taking this amount and has defaulted this amount very quickly via API. It will go a long way to to reduce the cost, because even with this blacklist, one of the things that they're doing is they're incentivizing the digital lenders to give data, because every time you give data and that data is used by another lender, you get to earn some money. So that incentivizes you to want to give your data for other lenders to be able to make use of. So that's one way that I see that collaboration can help to reduce the cost of the lending business.
That's interesting. If any, you have thoughts on that, please, because this cost needs to come down.
Yeah, I definitely agree. And again, nothing is impossible, right? I remember some years back when, the Jollowe used to have this is beginning of the year, what's it called, postulations or predictions.
Offices.
I remember when he said transfers will come to zero. And I was like, are you bonkers? I think at the time transfers were still like 50 naira, right? But hey, it didn't even take long. I think as of 2 years ago, we had started to see it with the likes of Kuda, OPay, that transfers can actually be zero, right? And I think that lending can also
Is it
You
still
know,
like that?
oh yeah, a lot of people still do. Kuda will give you 25 free. Carbon gives you 30 free. A lot of people are still doing free. Some are doing 10 naira. So yeah, well, at least to a large extent, somebody is a prophet wherever he is, right? And I feel like for lending, we can also get to that point where imagine maybe not the credit bureaus, right? Or it could even still be them, right? Imagine the credit bureaus came together to partner with an Indicina, and all the other data sources that we are going to pay for is something that you can get from the credit bureau, right? Or from one single source of truth. It considerably drops down the cost. Or imagine, the biggest cost from what I mentioned earlier was probably the credit bureau checks. So imagine there was even some sort of incentivization for lenders to say that, you know what, for every time you give us 1,000 records of your lending, you get, half the price for the next 1,000 records that you are calling from us. There are a lot of simple, small wins that we can do. Again, why are we spending so much to retrieve BVN, for crying out loud? It's like
Mm.
saying you want to check for somebody's social security number and they're charging you $1 or 50 cents. Like, some of these things are, forgive me, ludicrous, right? We are making money from checking BVN, something that is like charging for account number lookup, right? Which some banks used to do at some point. I don't know if they are still doing it, but let's not go there. But again, these
Okay.
things, there's no cost. It's not costing anybody anything. Maybe yes, support or infrastructure, but this cost can come down. I don't see why BVN check should be more than 5 naira in this country. Like, it's pointless. Checking statements. What if the banks, open banking becomes a thing, and the banks actually open up their APIs directly and say, you know what, forget, come and check this thing. But if you lend to our customer, there is a share margin, or in fact, maybe the open APIs can include statements and direct debits. Where, okay, if you give them loan, we can now make money from the direct debit. There are a lot of things that we can be exploring for competition, for to drop down this pricing. But collaboration is at the heart of it, where the whole ecosystem comes together to see that this is a win-win. It's not fintechs versus the banks. It's not digital lenders versus traditional lenders. It's just Nigerians trying to make Nigeria a better place for every Nigerian.
Thank you very much for that very passionate piece you just delivered. And it's true. And I trust in Nigerians, especially in Nigerian fintech's ability to innovate and innovate and, crash these things down by forcing incumbents or other people to think differently.